Good morning, everyone. I think it's a good time to start. Natalie's in charge of the slides today. So Natalie, if you'd like to move us on to the first slide, please. Fantastic. Good morning, everyone. Welcome to the first tax update webinar of the autumn series. My name is Malcolm Pengelly. These webinars will run monthly through to December, and we hope you find them useful. On the agenda today, we've got the usual quickfire news items. That's presented by Mark Ellis and myself. We've got a session on tax issues to consider for individuals coming to the UK. That will be presented by Nigel Giles and Sadiq Hashmi. And a tax dispute resolution update looking at some matters that are of great interest to HM Revenue and Customs at the moment: furlough fraud, domicile and residence, and R&D claims. And John Claypole, who's a partner in our tax dispute resolution team, is going to take us through that. There will be an opportunity at the end to provide a little bit of feedback. Natalie will put up a poll once we get to the end of all the sessions, and we'd really be grateful if you could complete that for us, please. It's only going to be up on the screen for about 5 minutes, so hopefully it won't take you terribly long. Next slide, please, Natalie. If you've forgotten what we all look like, given that we've been away for 2 or 3 months, that's us. So thanks, Natalie. There are just a quick reminder as to how to pop questions to us. Please use the Q&A function, which you should find at the bottom of your screen, and we will attempt to deal with those questions as we run through the presentations. Next, okay, you're on the next slide. Thanks, Natalie. There we go. So I'm going to deal with direct taxes. First item on the agenda, we think it's quite important, is we now have a new tax line email address. It's very easy to remember: taxline@bdo.co.uk. So no more trying to work out how many L's there are in Malcolm Pengelly. You can just send me, or indeed any of the team, a question to the taxline@bdo.co.uk mailbox. Hope you find it useful. You can, of course, still speak to us on the usual number, 0845 356 0006. We might all have been away on holiday, but things have been going on in the tax world during the summer season. So I'm going to talk about the basis period consultation, which has been out since July, and Chris Holmes and Francis Edwards did a very good article in Tax Journal, which you can have a little look at. It gives good background as to what's changing, but I'll try and run through it in a little bit of detail. And 2 very short items towards the end of my session about the extension of the trust registration service and the extra boxes that have now appeared on the CT 600 form. So let's deal with the Finance Bill 2021 basis period changes. So what are these proposed changes, I hear you ask? Well, for those who've been around a fair time, you'll be aware that currently sole traders and partners, who are individuals, are assessed to tax on the profits arising in the accounting year ended in the tax year. So, for example, a sole trader, Mr. X, making up accounts to the 30th of April 2020, next year 2021. That's what we've all got used to over the last 20 years or so. What the proposals are is to move from a current year basis to a tax year basis. So you'll be taxed on the results for the tax year. That's to the 5th of April, or alternatively to the 31st of March, either date we think will be acceptable. And when are these changes going to come in? Well, they'll come in for the 22-23 tax year. So if we look at Mr. X, who's got a 30th of April 2020 year end, that's going to form the basis of 2021. His results for the 12 months to 30th of April 21 will form the basis for 21-22. And 22-23, he'll be assessed on a catch-up amount. So he's going to be assessed on 23 months. So from the end of the basis period ended in 21-22, which is 30th of April 21. So from 1/5/21 all the way through to the 5th of April 2023. In other words, 23 months worth of profit. So what are the issues? Well, 23 months is a lot of profit. You know, when you're used to paying tax on 12 months worth of profit, paying tax on 23 months all at one go could be a bit of a problem. How is that alleviated? Well, a lot of people will have overlap profit. Some of it goes back many, many, many years and might not be a very large number at all, but you can deduct the overlap profit. And the proposals provide that the excess profit, i.e. the amount of profit over and above what would have been assessed in 22-23 under the old current year basis, can be spread over 5 years. So that's helpful. It's the profits that are spread, not the tax, it's the profits. So you're going to have to do some calculations, I think, because if you make the election to spread, then you're going to have to work out whether the taxpayer will pay more or less tax as a result of spreading. So our tax rate is going to go up over the next 2, 3, 4, 5 years. Are there tax shelters in 22-23 that one could make use of, but which wouldn't be available in 23, 24, etc., etc. So there's a little bit of discussion and thought to go into, should I spread or shouldn't I spread? Another point is, because we're going to be assessed on profits arising in the tax year, if you're not making up your accounts to 31st of March or 5th of April, you're going to have to prorate your accounting results to the tax year. So for example, if you make up your accounts to 31st of December, well, 3/12 of that will go into the preceding tax year, on which you'll pay your tax on 31 January following. But you might not even have the accounts for the December that's just finished. So there's going to be some estimation required and perhaps some truing up somewhere along the line, either by submitting a revised return or otherwise. We'll see what the proposals lead to in due course. So what should you do now? Apart from becoming the most popular partner in your business, when your fellow partners find out about these changes, because it's going to hit their pockets. Most people, I suspect, are going to end up paying more tax than would otherwise have been the case. So I think you need to start discussing with your partners what the cash flow implications are of this, and also think about whether the business should align its year end to 31st of March or 5th of April, just to make the admin easier. So there are a couple of things to take away and think about. Moving on, could you go back a page, Natalie? Sorry, I'm still on the direct taxes. There was a couple of small changes to pension tax in the finance bill. The normal minimum pension age, which is currently 55. Some of us are a long way past 55. I'm afraid to say. That will rise to age 57 from the 6th of April 2028. Doesn't apply to people in the armed forces, police and fire service pension schemes, but the normal minimum pension age is the minimum age at which you can start to take your pension. Of course, it depends what your pension scheme rules actually say as to when you can actually take your pension. The other change is the scheme pays arrangement. What is scheme pays? It allows an individual with an annual allowance charge of £2,000 or more, in other words, they've breached the annual allowance limit of 40k, to ask the administrator of the pension scheme by giving notice for the pension scheme to pay the tax charge. Now, currently that notice needs to be given by the 31st of July following the end of the tax year. That can be quite difficult. Administrators sometimes aren't that quick in getting the information to people to enable them to work out whether they've exceeded the annual allowance charge, particularly for final salary schemes. So from the 6th of April 2022, the deadline for giving notice is going to be extended to the earlier of 3 months from the day the scheme administrator gives the member information about the annual charge, or 6 years beginning with the end of the tax year in question. I suspect most tax administrators are slightly quicker than taking 6 years to do it. So I suspect it's the 3 month time limit you need to concentrate on. A couple of things to finish up with. The tax registration service, important for those of you who deal with trusts. To date, under the fourth money laundering directive, only what are known as taxable relevant trusts with which are liable to UK tax have been obliged to register under the tax registration service. From the 1st of September 2021, certain non-taxable trusts will need to register, and the time limit for that is 1st of September 2022. The rules are quite complex, but basically it covers all UK trusts except certain exempt trusts. For example, trusts imposed by a court order or legislation, estates other than complex estates, and trusts holding insurance policies. There's a great big long list of them. If you want to know more, because it's your area of work, there's an article by Gemma Davis in the July edition of Tax Insight magazine, or you can call the tax line, or even use the new tax line email address to contact us, and we'll get Gemma to make contact with you and run through the detail. And finally, from me, it's going to be CT 600 reporting season very shortly. There are some new boxes on the CT 600 return which relate to the coronavirus job retention scheme. They're boxes 471 to 474. They need a little bit of care in completing them. The three main boxes are box 471, which basically asks you to include all CJRS payments that have been received. This is the gross figure before adjusting for any voluntary repayments made or HMRC assessments. So it's the gross figure. The 472 box is how much you are actually entitled to claim. It sounds obvious, but it can't be any higher than the number in box 471. And box 473 is how much has been assessed or disclosed to HMRC. So those boxes are going to be looked at very closely by HMRC. They're going to use it to see if people have paid the right amount of or claimed the right amount of CJRS, and if they've got stuff to repay, that they've repaid it. Don't, whatever you do, just automatically put the same number in box 472 as you put in box 471 without checking. And if you've got any queries, or you think, well, actually, now's a good time to just check I've made all the claims and made the right claims for CJRS, do call the tax line. That's it from me. Now over to Mark for the indirect tax matters. Mark, over to you.
Thank you. Just two quick points for you to check amongst your client base. These are recent announcements from HMRC. The first one is clarification from HMRC of their views about the VAT liability of coronavirus testing kits as well as services. So you may have clients who are buying these in for their own use or to sell them on, or providing, selling kits and or services. In general, if it's just goods alone, that's vatable. Services may be exempt, depending on who's providing the testing service. The revenuer, they've accepted that it's a supply of medical care, even though it might be for the purposes of being able to travel or something like that. So it's useful to have this finally from HMRC, their views, and it's worth checking whether any of your clients have been charged VAT incorrectly by suppliers, and or have been charging VAT or treating something as exempt in terms of their supplies that they make to their customers. If they do that as well, and correcting the position. The second one is around the VAT treatment of gaming machine income. The revenue have caved finally. It's a reasonable period. It's just over a 7-year period, 7 and a bit year period, which for some businesses that's quite a lot of money. This isn't something to actively make a claim for now, but the window of opportunities to do so is long past. So you may have clients in your client base who currently own companies that operate these gaming machines, or did do in this period, and your client itself has made the claim to HMRC, which by now should have been rejected and appealed and stood behind the lead cases, which HMRC have now folded on. And we've seen another situation, just because of the passage of time, your clients may still have a right under a share purchase agreement that they entered into a while ago, when they sold a business, a company that operated gaming machines, and that company made a claim, and one of the clauses in the share purchase agreement says that any VAT refunds coming to the company in light of this brief or similar find their way to the previous shareholders, which is your client. So that's worth checking whether you've got those clients in your database. The key thing I would say is that the revenue are repeating a trend they've already done to do with VAT claims over long periods where they have conceded the principle. So we've seen this before with golf clubs and green fee income, and they've accepted that they should be, they can be VAT exempt, not vatable. And we've also seen it with VAT bad debt relief claims from a long time ago, 78 to 89 period, so a period a long time ago. They've accepted the principle, but they have insisted, and they've done it again here, that there is a higher standard of proof for the claimant. So they do state in this brief that they will need to see documentary evidence to demonstrate which category of gaming machines, there's different categories for gambling commission purposes, that were operated by the claimant throughout the claim periods. So that's a decent period, 7 and a bit years. And if you can't get everything, you need to tell them what evidence you're missing, what steps you have taken to retrieve it, and the reasons why it is not available. It's they're putting people to task on the records, which may, given the length of time, be gathering dust somewhere, or may not have been retained in the first place. So in which case you may stumble for your clients in trying to get money out of HMRC. So that's two things that you should think about across your client base. Thank you very much.
Okay. Next slide, Natalie. We don't have any questions at the moment. If anybody wants to pose one, please do feel free. We can pick them up in due course. There's doesn't seem to be anything coming through, in which case I will hand over to Nigel and Sadiq. Next slide, please, Natalie.
Thanks, Malcolm. Can I take next slide, please, Nat? Good morning, everyone. Over the next 15 minutes or so, Sadiq and I are going to take you through a general review of the main points to be aware of when advising an individual is coming from abroad to live in the UK. We don't have sufficient time in this slot to go into any great detail, but we hope you find this useful as a high-level refresher as to the matters that need to be considered. In this talk, we'll cover the items listed on this slide. Sadiq will take you through the general principles behind the residence and domicile rules and their implications for the main personal taxes. And I will then talk about the remittance basis and highlight some planning points to think about on arrival. To wrap up, I'll also cover off some CGT issues to consider on departure. I'll now pass you over to Sadiq to get us started.
Thank you, Nigel, and good morning, everyone. So, becoming UK resident. Now, the main point here to consider is once you become UK resident, you're taxed on your worldwide income and gains. You have to pay UK tax on that. Unless you claim the remittance basis, you can only claim the remittance basis if you're non-dom or not deemed dom. Nigel will talk about that more later. It's also relevant for inheritance tax purposes because of the new deemed domiciles rules, which came in from 6 April 2017. The way to determine whether an individual is UK resident is by going through the statutory residency test, which came in for tax years from 2013 onwards. Before then, there was UK ordinary residency tests, which are important for you to consider when you consider the deemed domicile rules. So if you go on to the next slide, we can consider the statutory residency test in more detail. So an individual is UK resident if he meets any of the conditions of the automatic UK tests, and he meets none of the conditions for the automatic overseas tests. If none of the automatic UK tests are met, and none of the automatic overseas tests are met, an individual can still be UK resident if he meets the sufficient ties test. So the inverse of that is if an individual is non-UK resident, if he meets any of the automatic overseas tests, or he meets none of the automatic UK tests and he meets none of the automatic overseas tests, and finally he meets none of the sufficient ties test. The conditions are varied and modified for those who work on ships, planes, or lorries. They're individuals that have relevant jobs. If you go on to the next slide, bit more detail about how to meet any of the conditions of the automatic tests. So remember, you only need to meet one of these conditions to fall as automatically overseas. So only one of the three conditions. So less than 16 days in the UK if you haven't been resident in the UK for the past 3 tax years. Less than 46 days. If you're UK resident, if you're in the UK for less than 16 days, if resident for one or more of the previous 3 tax years, you only have to be resident in the UK for less than 46 days. If you're not resident in the UK for all of the previous 3 tax years, and if you meet the work abroad test, broadly, that's where you work full-time overseas, you'll also be automatically overseas. If none of the above tests are met, you may still be non-resident if none of the automatic UK tests are met and you don't have sufficient ties. So going on to the automatic UK tests, if you've been resident in the UK for more than 183 days, you will be UK resident. If you have a home in the UK, broadly this means if you're present at least 30 days during the tax year and 91 consecutive days in which the individual either has no home overseas. One of the important things to remember here is it doesn't have to be a home that you own or lease. It can just be somewhere where you live. And lastly, if you work in the UK full-time, you will be UK resident. So most secondees from overseas are UK resident. If you go on to the next slide, please. So going on to the sufficient ties test, this applies where you've met none of the automatic UK tests, and you've also met none of the automatic overseas tests. The sufficient ties are all listed on the right-hand side of the page. So family connections are your spouse, your civil partner, or your minor children. If they're UK resident, you meet one of those ties. Accommodation is whether you have a home. Work is whether you work sufficient hours in the UK. One of the most important things to remember here is the more days you spend in the UK, the less sufficient ties you need to complete this test. So if you spend more than 120 days in the UK, you only actually need to satisfy one of these tests. If you spend less than 46 days in the UK, you may need to satisfy 4 of these tests. You also need to satisfy less of these tests if you've been UK resident in any of the preceding 3 tax years. Next slide, please. Now, moving over to the domicile rules and deemed domicile rules, the main tax consequences for this is for inheritance tax. So if you're UK domicile, you will pay inheritance tax on your worldwide assets and not just your UK situs assets. For income tax and capital gains tax, this becomes relevant because you're taxed on the arising basis once you become deemed domicile, and you cannot claim the remittance basis. Next slide, please. Now, there are 3 ways that you are domicile for UK purposes. Domicile isn't a tax concept, it's a legal concept. So the 3 ways you are domicile is, firstly, is domicile of origin. So we all have this as soon as we are born. Your domicile of origin is the domicile of your father if your parents are married. If your parents are not married, it's the domicile of your mother. The second way you can become domicile is domicile of dependency, and that applies for children under 16. You should watch out for the age changes that came in also. So that's basically, if you're a child under the age of 16, your domicile is the same as a person you are dependent on, which is usually your father. The third way is being domicile of choice. And the main things to consider here is where you live and your future intentions. So if you live in the UK and you plan to live in the UK for a very long time in the future, your domicile of choice is likely to be in the UK. Next slide, please. Now onto the rules about deemed domicile. These came in from 6 April 2017. There's 3 ways an individual can be deemed domicile. Probably the most common way is the long stayer in the UK. So if you're a UK resident for the last 15 years out of the last 20 years, you become deemed domicile. Even if you leave the UK in the 16th year, you're still deemed domicile for that tax year. You can lose this deemed domicile status for an income tax and CGT purposes after 6 years of being non-resident. So the second way you can become deemed dom is the returning foreign dom. This applies where for individuals that were born UK resident and had a UK domicile of origin in the UK, they subsequently left the UK and acquired a non-UK domicile of choice. And later, as soon as you become UK resident again, you become deemed domicile. The third way, and this is important to remember, is only for IHT purposes, and it's for non-dom spouses or civil partners. So a non-dom spouse can elect to be domiciled in the UK for inheritance tax purposes only. That can be beneficial because all property can then be transferred from their spouse IHT free. If they didn't make the election, a non-dom spouse can only get property transferred to themselves from their spouse, and that property is subject to the nil rate ban for IHT purposes. And always the disadvantage of making this election is that the non-UK dom partner will be fully taxable on their worldwide assets instead of just their UK assets. Back over to Nigel, who will talk more about the remittance basis in the next slide.
Thanks, Nick. Right, the remittance basis. The remittance basis is available if the claimant is not domiciled in the UK under general principles and not deemed domiciled in the UK for income tax purposes under any of the rules that Sadiq referred to in the previous slide. It is only relevant to UK resident taxpayers. If a UK resident non-domiciled taxpayer claims a remittance basis, the tax charge on non-UK source income or gains will be restricted to income or gains that are brought into the UK. If unremitted income or gains are subsequently brought into the UK, UK tax will be charged at that time. The tax rate payable will be the prevailing tax rate in the year that the funds are remitted, with a proviso that all investment income, including dividend income, will be taxed at the savings rate, i.e. 20%, 40% or 45%. Credit will be given for foreign tax borne on the overseas income or gains. The definition of what constitutes a remittance includes the following. There is a remittance if foreign income or gains are brought directly or indirectly to the UK, and the taxpayer, or a relevant person, which is broadly a connected person, can enjoy the benefit of the income or gains in the UK. There is a remittance if a service is received in the UK and the service is paid for using income or proceeds from gains that arose outside the UK. There is a remittance if foreign income or gains are used to buy an asset in the UK. If an asset is purchased overseas using foreign income or gains and is then brought to the UK, that will in many cases be a remittance as well. If UK debt is settled using foreign income or gains, using credit card for example, that would be a remittance. The remittance basis is a claimed relief and requires a claim to be made each year, typically on the annual tax return. In the absence of a valid claim, the UK resident taxpayer is subject to income tax or capital gains tax on their overseas income on the arising basis. There is an exception to the rule requiring a claim where the total of overseas income and gains for the year is less than £2,000. There is also an exception for recent arrivals where the taxpayer has no UK income or gains in the year and has made no remittances of untaxed income or gains. As noted on the slide, there are downsides to making a remittance basis claim. Personal allowances and the CGT annual exemption are not available for the year of claim. For longer term residents, there is also a fee for claiming the remittance basis each year. This annual fee, known as the remittance basis charge, is £30,000 if the taxpayer has been UK resident in at least 7 of the previous 9 years. This fee increases to £60,000 per annum if the taxpayer is UK resident in at least 12 of the previous 14 years. If the taxpayer has been UK resident in 15 or more years out of the last 20, they'll be deemed domicile and the remittance basis is no longer available. In theory, the remittance basis charge is available as a credit against the UK tax charge when the funds are remitted, but in practice this credit is only likely to be available if all funds are remitted. There are complex rules around disclosure, and as a general comment, it's wise to take specialist advice if claiming the remittance basis when the remittance basis charge is in point. To the next slide, please, Nat. On this slide, I've jotted down some general thoughts about points to consider when advising a client who is about to move to the UK. What's the date of arrival for tax residence purposes? It's not always appreciated that the split year rules under the statutory residence test are very mechanical. If the taxpayer's circumstances do not meet the precise criteria of one of the 5 cases in the legislation that apply to arrivals, the date of arrival will not be the date of physical arrival. Instead, it will be either the preceding 6th of April or the following 6th of April, depending on the timing. I've not mentioned it on the slide, but don't forget to consider the resident's position in the country that they've left. There may be treaty residence issues to think about if there is continuing residence in another jurisdiction. There may also be some overlap of dual residence, given that tax year ends are likely to differ. Are there continuing overseas income sources? If there is employment income, for example, the situation can become very complex. For non-domiciles with continuing overseas duties, overseas workday relief is potentially available in the first 3 years of UK residence, where they are paid abroad and the foreign earnings are not brought into the UK. Does NIC need to be considered? This is also a complex area, and we had originally thought about including some commentary on NIC in this talk. We didn't feel we had time to cover it properly. If there is interest, we can return to this as a dedicated topic in a later session. Are there unrealised gains or lump sum payments that could or should be realised before arrival? Obviously, this depends on the respective taxing rules and rates of the UK and the previous jurisdiction. The UK CGT rate is relatively low at the moment in comparison to many other European CGT rates. On the other hand, CGT rates are lower in other jurisdictions, and some countries don't apply CGT at all. Are there continuing overseas business interests? If the owner of an overseas company is relocating to the UK, might this mean that the management and control of the company is relocating to the UK as well? If so, this will bring the company into the UK corporation tax charge. An overseas self-employment will almost certainly be relocating to the UK and commencing as a UK business when the proprietor moves here. Is the remittance basis available? And if so, is it worth claiming? As discussed on the previous slide, remittance basis might achieve some saving, but this is not always the case. Clearly, it won't be of much benefit if the intention is to bring the funds into the UK anyway. Bear in mind also that foreign tax credit relief may limit the UK tax exposure. Account segregation. If the taxpayer is a non-dom who is expecting to claim the remittance basis, account segregation before arriving in the UK is arguably the most important planning point to think about. Income and gains accruing prior to becoming resident in the UK are outside the scope of UK tax. Such funds and other sources of clean capital can be brought into the UK without tax consequence. However, if clean capital funds become mixed in the same account with income or gains arising after becoming resident, when funds from that account are remitted to the UK, there are strict ordering rules and legislation which determine which source has been remitted first. The rules are often not straightforward to apply, and generally speaking, the ordering rules will favour HMRC. In this situation, there is a clear benefit in persuading the client to undertake an account segregation exercise to ring-fence the clean capital. They should also consider separate accounts to ring-fence funds where remittances might attract a lower UK tax liability, for example, capital proceeds or income taxed in the country of origin. By the same token, funds that are identified as potentially taxable unremitted income might be matched to offshore spending. Is UK property being acquired? What funds will be required and used, and who will use the property both short-term and long-term? The use of structures using overseas companies to own UK residential property is no longer effective for CGT or IHT purposes, although there is still, for the moment at least, some scope to use them as a shelter against IHT on UK commercial property. Are overseas funds required for UK business investment? Business investment relief may be available for a non-domicile remittance basis user. BIR allows the use of unremitted income or gains for investment in a qualified business operating for an eligible company. The investment funds brought into the UK would not be taxable if the proceeds are immediately taken back offshore once the investment is realised. IHT considerations. If the taxpayer is not UK domiciled under general principles and not deemed domiciled under the specific IHT rules, they will be subject to UK IHT on UK citus assets, but not to UK IHT on foreign citus assets while they remain non-domiciled. If there is an expectation that this domicile status may change, there may be scope for planning to protect the UK IHT exposure on the foreign assets while they remain non-domiciled for IHT purposes. The final point of the slide is just obviously don't forget the UK tax registration requirements. The next slide, please. Right, I don't have much to add to this slide. The left-hand column expands on some of the earlier comments about considering whether to release gains before arrival and the potential pitfalls if you're forced to rely on the remittance basis, particularly if funds have become mixed. The right-hand column briefly outlines the capital loss position. If the arising basis applies, foreign capital losses are allowable against other gains, including UK gains. A remittance basis user, on the other hand, can't make use of foreign losses except when they make a foreign loss election under Section 16ZA, TCGA 1992. The time limit for this election is 4 years from the end of the first year for which the remittance basis is claimed. The election is irrevocable and can have unexpected implications in terms of reporting requirements and the offset of losses. It should not be made without careful consideration of potential outcomes. Next slide, please. Just to wrap up, the final two slides concern capital gains tax implications of leaving the UK. With certain exceptions, non-UK residents are not subject to UK tax, even if the assets disposed of are UK assets. The exceptions are, firstly, gains that fall within the scope of the temporary non-residence rules, which we'll discuss on the next slide. Secondly, UK property, residential property, any gains that have arisen from April 2015 onwards, and commercial property and gains deriving from UK property-rich companies, gains arising from April 2019 onwards. Thirdly, chargeable gains used in a trade carried on through a UK branch or agency may be taxed on a non-resident. Can I have the next slide, please? The final slide refers to the temporary non-residence rule. This is an anti-avoidance rule aimed at discouraging short-term immigration from the UK to dispose of an asset pregnant with gain in a more tax-favourable jurisdiction. The temporary non-residence rule applies to any capital gains assets held at departure if the disposal of the asset takes place during a period of at least 5 years, throughout which the seller of the asset is resident outside the UK. There is no UK capital gain. The 5-year period starts on the date of departure for tax residence purposes and ends on the 5th anniversary of that date. If the seller resumes UK residence within 5 years, the untaxed gain is treated as having been realised in the year of return. The temporary non-residence rule was extended from 6th of April 2013, and similar provisions now apply to certain income tax-related payments. These include distributions from closed companies, chargeable event gains, and lump sum payments from UK registered pension schemes. This concludes our presentation, which I hope you found useful. I'll be happy to take any questions either now or at the end.
Thanks, Sadiq. Thanks, Nigel. We've got one question from James, probably for Nigel, I guess. James has asked, should deemed domicile taxpayers complete the non-resident pages of their tax return to denote their deemed domicile status? And he goes on to say, as they are taxed on the arising basis, is it relevant?
Good question. Possibly not. I'm trying to think if you're going to be paying on the arising base. I mean, bear in mind you've got slightly different rules for IHT and for income tax. So I think I would be inclined, if you think you're non-domiciled under general principles, I'd still want to mention that somewhere on the tax return. But I don't know if that necessarily requires you to complete the residence page.
Very good. Okay. We've got a question. Can we have the slides, please? Natalie's responding to that. I suspect the answer is probably yes, but I'm sure Natalie will let us all know. Any other questions on Sadiq and Nigel's slides? If not, let's move on to John, who's going to give us a TDR update.
Thanks, Malcolm. Good morning, everybody. Conscious of keeping to time. So, Natalie, if we can move on to the next slide, please. As Malcolm said earlier on, we've got 3 subjects to cover: furlough fraud, domicile and residence, technical inquiries, and R&D claims. The reason I've raised these is simply because in my day job of only dealing with HMRC in all its different guises and across our team, there's 40 of us in London, these are the 3 most topical issues we're seeing in the private client stroke owner managed business space. So without further ado, Natalie, if we can move on to the furlough fraud. Next slide. So yeah, just taking start reflecting before this session, actually. Prior to March last year, I'd never heard of furlough. I'm not sure how many of us actually had, but it's fair to say that it went through a number of changes very rapidly from March last year. One of my employment tax fellow partners told me apparently at one point it changed 4 times in one day, which is fairly scary. So because of that, frankly, it's pretty easy for clients to get claims wrong, not through any mischief necessarily. And we know it's coming to an end, I think, next Thursday, 30th of September from memory. So But sadly, in some quarters, it's been used and abused. And HMRC is required, and I'm sure the Treasury's had a little chat with them as well to say you need to kind of redress the balance and start to recover any overpayments. So it's geared itself up. It's moved some resources around. I'm aware that there's at least 200 investigators now doing CJRS claims, stroke furlough fraud claims. And they produced a taxpayer protection task force. So they're targeting roughly 30,000 mid-sized businesses. I think the NAO has estimated that 7 billion of potential fraudulent furlough claims. And it's estimated 10% of the million businesses that made a claim have made the claim incorrectly. Not necessarily as a result of any mischief. As I said, it's complicated, it's difficult. And we'll come on to it in a moment, but basically HMRC is now inviting employers to make a full disclosure of any correct claims, using its statutory information powers if it needs to, and where it also feels a need, it has introduced the fraud investigation service as part of the task force. So COP 9, Code of Practice 9, which is suspected fraud, will be used. And indeed, for more serious matters, they're considering criminal proceedings, and there have been half a dozen raids already by the FIS teams in HMRC on the more serious end of the spectrum. I was going to raise the point around the corporation tax return, but to show how joined up we are, Malcolm beat me to it. But I think, just the point I'd make there is that, and just re-emphasize Malcolm's point, that that's the time where the client's got to focus their minds again in relation to CJRS claims and the accuracy of them. And frankly, I would have, because it was so difficult and so easy to get wrong, I'd be urging every client, frankly, to check the claim before they sign the corporation tax return. So Natalie, if we can move on, we just got here, and with apologies for the small print, this is an example of a very recent letter, 27th of August, nudge letter from the task force. It's headed up the CEPET team, which apparently stands for Customer Experience, Professionalism and EU-UK Transition. Quite how that fits with CJRS, bit of a mystery to me, but clearly that team, or whoever is in charge of that team, quite fancy doing this type of stuff, and his or her team has got responsibility for doing these compliance checks. I'm not going to run through the letter because the print is small, but on the second page you'll see 16 bullet points basically asking for full names and addresses of every employee, the start end date of furlough, basically chapter and verse about the furlough claims. Bearing in mind there were multiple claims. There's no sample testing, so it is literally everything for every claim, for every employee. You'll see at the bottom of page 2, a letter dated the 27th of August, inviting a full response and all that information by the 13th of September. Now, I'm sure it will be possible to get extra time, but basically, that they're expecting clients to turn their minds to this. We understand as well that the agents, us, are not getting copies of these letters. These are going straight to our clients. So it's quite possible you've got clients with these letters and they're going, oh, another HMRC letter, I can't face that, put it to one side. They need to turn their minds to these things because really ignoring them isn't an option. So very topical, and clearly from HMRC's perspective and Treasury's perspective, some big numbers out there that they want to make sure are correctly addressed. So Natalie, if we can move on to domicile residents, technical inquiries. Obviously Nigel and Sadiq have given you the chapter and verse in terms of the technicalities. From my perspective, we are seeing an increased number of specific inquiries into domicile and residence. There are now we've seen a number of nudge letters, a bit of a trickle, to be honest with you, 6-9 months ago. But our private client team in London had 3 land in one day last week on its client base. So it's turned into more of a wave rather than a trickle. The key issue is focusing on the residence and domicile of choice. As we will all probably be aware, matters of residence and domicile are very, very fact sensitive. And there seems to be some greater interest in obtaining a domicile of choice, and HMRC alleging that. And as I think it was Nigel said in the previous slide, that the onus is on HMRC to prove that, but nonetheless, the way they're doing that is asking for extensive information requests. And just because of the nature of these things, dealt with many over the years under the pre-stat residence test and now current rules, it's almost inevitable you're looking at a protracted and frankly probably expensive inquiry into your client's tax affairs. The Empiricos case, whilst that focused on the application of partial closure notices, for me in my world, terribly interesting and relevant, the backdrop to that case was actually it was a residence domicile investigation, HMRC asking for extensive information as is its norm. Tactically, it was decided to try and push them into a closure notice environment. So the challenge was around, well, they were saying, look, we can't issue a closure notice until we've got the information we need to work out if there is a liability. So there was a bit of push and pull in relation to that. In the end, at the upper tier tribunal, HMRC won, and basically the information needs to be provided to enable the determination of his status for residence domicile purposes. So, but as I said, interesting for me in my world in relation to the application of partial closure notices. The next slide, Natalie, if we may, is a anonymised, protect the guilty or innocent, whichever view you take. But I'm not going to, again, apologies for the small print, but basically it is a fairly standard letter actually, talking about remittances, how difficult they are. We're seeing common errors, and it is difficult. The guy said, talked about it earlier on, didn't get into the detail that would really flesh it out, but it is difficult to get the remittances right. Extremely difficult, and banks get it wrong. I'm acting for a client at the moment where the bank has got it wrong. But basically, the bottom of page one is what you need to do now is within 60 days of receiving this letter, look, check, and act now. So basically, they're basically saying look at it all over again and contact us if you need to. Towards the end, going forward, if the remittance basis claim is incorrect, we may open an investigation. But I think it's fair to say in practice, if a client ignores this letter or doesn't respond or is tardy, there's going to be an investigation, and that is entirely consistent with what we've seen. And as I said, it's probably then going to get into quite a chunky investigation that needs to be dealt with. Natalie, if we can move on to R&D claims. My personal view of R&D is this has been an accident waiting to happen for a number of years, and I think, frankly, because there have been a lot of claims made without substantiation, and I've seen examples of it. I think the way certain boutiques have operated, in particular on pure contingent fees, clearly I suppose lends itself to kind of pushing the boundaries, and I think HMRC has finally woken up to it. As I said, I've been expecting it for a number of years. There's an additional 100 R&D investigators. We're seeing investigations now very regularly, either run by the wealthy mid-sized business compliance or the fraud investigation teams under Code of Practice 9. A number of what we found with R&D claims, we're seeing a number of them coming out of transactions. So, for example, private equity houses buying businesses, the due diligence exercise has identified that the R&D claims are not particularly robust, so they're requiring disclosures and to be regularised. As I said, we've seen a number of inquiries increase significantly. An example, and picking up to my comment earlier on, we're acting for a client at the moment with a £3.6 million R&D claim prepared by a boutique on a purely contingent fee. And unfortunately, so far, pretty much 3.6 of it is likely to be incorrect. As it was described by one of my colleagues working on that, the view taken for the claim has been the opposite of prudent. What are the things that HMRC seem interested in? Certainly, looking back in time, considerable focus on the qualifying expenditure, in particular things like staff costs, which tend to be the largest part of the claim, and not all the costs when you actually drill into it are actually relevant for the R&D activities. Definition of consumables and software. The application of software seems to be quite topical as well. If we can move on, Natalie, keeping to time. This is just a sample letter, pretty standard. We're seeing that corporation tax inquiries have opened under Para 24, Schedule 18, and just asking the full range of questions about the R&D claim, which actually isn't on this slide because it's quite lengthy and not even harder to read than this slide. So, but it's under corporation tax inquiry rules. So all the usual checking a taxpayer's tax position, and the information that's got to be provided is in the power or possession of the company, who of course act through its officers. Just finally, on R&D, Natalie, if we can move on to what I think is the final slide. The Haddy engineering case, if you've got an idle moment or suffer with insomnia, worth a read. It's only 21 pages long. It is kind of the case that is demonstrated the way HMRC is looking at investigating R&D claims, certainly in the SME regime. There's some history between HMRC and Haddy, because if you put in a wider search for Haddy in Bailey, you'll see that he's had a long-running battle with HMRC. Mr. Lowe, the guy that owns it, he is subject to Code of Practice 9. And the relationship between him and Mr. Riley, the investigator, is fair to say I don't think they send Christmas cards to each other. From an R&D perspective, there were 7 projects, and all 6, there were 6 rejected and the 7th only partially accepted in a very small way. There was fundamentally no proper record keeping. The subcontracting was not really compliant. There was no risk and reward. There was questions over what qualifies for scientific and technical advancements, and our own R&D team used this case as an example to demonstrate that, as with anything with HMRC claims, you need evidence, you need to be able to support it, you need to be able to document it. And probably what was the final nail in the coffin for Mr. Lowe's case was that paragraph 234 of the tribunal hearing, the judges said that his evidence was vague and sometimes contradictory. And then he also made errors in his witness statements, which basically undermined his credibility throughout. So that probably didn't help their overall view of things, ignoring the technical analysis, which was clearly flawed as well. So very, very, very topical R&D. I personally think we've only just started the R&D investigation journey from HMRC. So I think, Malcolm, that's me bang on 11 o'clock.
Thank you, John. And we don't have any questions for you, I'm afraid. Sorry about that, John. If anybody does have anything while I'm wrapping up, then do please bung it in the chat, and John will have a look at it for you. Next slide, please, Natalie. Lovely. So here we are. Oops. Thanks, Natalie. So you can get hold of us. There are our telephone numbers. You can call us on the tax line. And Natalie is going to send around the feedback questions, and we really appreciate you filling it in. We do. We're very grateful for that. It's come up on the screen now, so please fill it in. That'd be great. Thank you. And it just leaves me to say thank you very much for your attendance. The next update is on the afternoon of Wednesday, the 20th of October at 2 o'clock. Look forward to seeing you then. And do please have a good day. Thanks very much indeed. Bye for now.